Hello, everyone, and welcome to today's cryptocurrency, no, major markets update for March 5, 2022. Fortunately, I could not do a update on Friday yesterday because my entire life happened in one day. It seemed yesterday, so a lot of things unfortunately going on, but they were all pretty reasonably okay. So nothing too bad, but sometimes life gets in between. Life gets in between our own life. It gets in between the markets and all that stuff. So regardless, it's not the end of the world. Neither are the markets going down the end of the world. And no, the end of the world is not upon us. I'm rather confident of that. So let's have a look then at what the price charts are telling us and not have a look at what other people are telling us what we should see or think. We don't have opinions. We're only going to assess the price and move forward from here. Because so far we have a textbook unfolding of the short-term corrective price action. And let me show you, right, where we were on Monday, then Wednesday, and then, well, Friday or Saturday, so to say. And I'm going to start off with the Nasdaq. Remember, on Monday, I said, I spy with my little eye 5 waves up. That remains, and I continue to label it as a 1A. Okay. Again, we can still go below the February 24 lows. As long as those hold, we have the initiation move of a new bull run underway. Most likely, that is my preferred view. So 5 waves up is either 1A, then we got 3 waves lower. I said we would go lower on Tuesday, and that happened. After 5 waves up, always expect at the minimum 3 waves down. That's what we got. So technically the correction could have been completed. So I wondered on Wednesday, is this all of wave 2B, this is the green arrow, or are we going to revisit a little bit lower because we got the rally, which can be a B wave of a flat. Yes, 3, 3, 5 pattern. So I penciled this in on Wednesday. I haven't changed anything in this chart other than adding a few labels, A, B, C, and look what happened on Thursday, Friday. Continue to decline, and this is literally the two options the market has. Loud and clear. It always has two options, right? It could already be in the starting gates of wave 1 of 3, as I, for example, showed you here for the S&P 500, not here for the Nasdaq. And then we would have a wave 2 and then higher, okay? Or a wave B, and it turned it into a wave B. That was the preferred view. And I said we should then drop to about these levels. This was the target zone right here. And look where we bottomed. Now, since on Thursday we gapped up at the open a little bit, we can move this here. And we move this here. And look where exactly we bottomed. Right picture, perfect. Not a bad forecast. So far there is complete method to the madness. Nothing out of the ordinary. So far, the market seems to have made a irregular flat wave 2B as long as we're holding this low made on February 24th. That remains the same. That is now the line in the sand. The shorter term line in the sand was the Tuesday low. Right? The Tuesday low would then, if it held, allow us to set up a 1, right? A 1, 2, 3, 4, 5 setup, but it didn't. So then it morphed into this B wave, which I already had on the charts. Just a little bit higher than expected, right? I had it here, well, we got it there. All right, Crimea River. So now, if this is then indeed a flat, we need to have a 3, 3, 5 correction. What do we get? 1, 2, 3, 4, potentially a failed fifth wave 5 of C. Okay, and then this is then wave 2B. Okay, so far so good. Take this away. So far so good. And where did we bottom? Just a little bit south or north of the 50% retrace of this rally since the February 24th flow. Nothing out of the ordinary, a very normal wave 2B. I already mentioned this on Monday. The wave 2B will bottom anywhere between the 23.6 and the 76.4%. So nothing out of the ordinary has happened. We don't need to do any chicken little runs. I already told you, and everybody else who doesn't know this is doing the chicken littles. But so far, we have a very normal price pattern with a 335. Nice, and I like it. There's nothing. This is very normal. All right. So far, so good. So unless we break below the February lows, with I set the warning below the 76.4% retrace, nothing out of the ordinary. A standard 50 to 62% retrace for a wave 2/B is quite normal. Okay, and of course I continue to label it as 1 or A, 2 or B in green, because we don't know yet if it's going to be 3 waves higher, 535, or the impulse. I prefer the impulse. Just as we didn't know this was really going to be a B wave or one first wave of the green 3/C. I'll show you that in a minute, better detail for the S&P 500. We have potential positive divergence on the hourly RSI 5. So that looks so far so good. We can still get a little bit of a stab lower here into the ideal wave 5 target zone, around 13,150 on the Nasdaq, but it's not necessary. Okay, again, we've reached the ideal target zone. On Wednesday, I had it here. Okay, this was the ideal target zone on Wednesday. All right, since we gapped a little bit higher on Thursday, we have to raise the ideal target zone, but it fits even better. You can see how picture perfectly it reached 161.8% extension for this gray C wave, which is quite normal for what we then call this is a irregular expanded flat. So for textbook, nothing out of the ordinary just yet. Monday's call was correct. Wednesday's call was correct. So far, so good. That's 2 out of 2. So the Nasdaq is on track. How about the Nasdaq 100? This is the chart from Wednesday. So let's start digging into it. I haven't changed anything on the chart of Wednesday. Okay, so I'm going to zoom in. There it is. On Wednesday, I then said we should bottom somewhere around here. Okay, with a low of around 13,800. How low did we go? 13,740. Off by 60 points on 14,000. Pretty much Crimea River. Why? Because on Thursday we kept open a little bit higher. Thursday actually looked really good. It didn't go too well. So far so good. Okay, so we can raise this a little bit there. So then this is wave B, right? This is what I showed you, that we either going to bottom. Let's use this one instead. Okay, we're either going to bottom here because we did 3 waves lower, or we have the alt. Well, the market choose the alt path. Fine with me. Okay, so we have, of course, the length of wave A. We measure it from the top of wave B. Okay, so this was then wave A, and this was then wave B, and then this was, of course, micro A, micro B. There, and then this should ideally be wave 2B. And so far, we've bottomed right in the ideal wave 2B target zone here in red. So nothing out of the ordinary at all. We need to break below the 76.4% extension to make that a much higher option that we're going to revisit the February lows or even a little bit lower. So this is then B. So did we get 5 waves lower? Okay, let's have a look. This is hourly chart, and up hours are now corrective waves, 2 and 4. Okay, so here we go. This is then 1, this is then 2. That was the bounce on Friday. And remember, so the market is always at this crossroads, right? It's getting information and we'll decide what to do with it. Unfortunately, the news of this attack on the Ukrainian nuclear reactor hit the market before the fantastic economic report came out that more jobs have been created, that less people are unemployed, salaries have increased more than anticipated. And honestly, the market is economically oriented, and that is a more important news than attack on a nuclear power plant, which cannot explode. Nuclear power plants are not nuclear bombs, they cannot explode. Anybody who's done pretty much high school physics knows that nuclear power plants don't explode. But the market took that information and interpreted into this. Instead of a 1, it turned it into a B. This is where the market keeps its options open at all times. And now we have 5 waves lower. Okay, so this means that if we get a breakout above this week's highs at any given moment, we are in the wave 3C. So that is 5, clear 5 waves lower. Okay, so originally thought we'd bottom there. Okay, we bottom right here. Again, that's then the ideal target zone. Looks good. 5 waves lower. Can become more complex, this wave 4. That's fine as well. But technically, there are enough waves in place. Okay, technically, there are enough waves in place. We can still have that little step lower, as I showed you for the Nasdaq. We can have the same, of course, for the Nasdaq 100. Oops, sorry. Where is there? That's the chart. Oh, this is the chart. Sorry. So many charts. And then we have wave C. Okay, so we can still step a little bit lower to the 62% retrace. It's fine. Nothing out of the ordinary just yet. Okay, so far so good. So we can still move around a little bit. First warning for the bears is, of course, overlap with this wave 1 low. Right, this is going to be the warning for the bears, because then the 5 waves lower have completed. Same, of course, here. First overlap with wave 1, and then most likely we are going to move higher for wave 3C. So far, so good. It is still following normal textbook pattern behavior. Let's move to the S&P 500. Haven't changed the chart since Wednesday. I wanted to, but I want to show you what I had on Wednesday. I said on Wednesday, we either have completed wave 2B here, that was right, or we're going to go here. Nothing has changed. Well, it's going to go there. So then I labeled this as 1A, 2B, and this is 1B, 1/B, right? So that's what we got. We turned it into a B wave. So this wave 2 is now going to be here. So far, we've done nothing out of the ordinary. I also mentioned that this wave 2 should have bottomed here and then we break out. Well, and if we would go below 4324, we would go here. So far, this has been following along textbook. So it can't be a wave 2 anymore. This is the immediate text bullish setup that I mentioned in my tweets, that we had this potential immediate bullish setup of a 1, 2, 3, 4, 5. Well, the market decided to take door B, literally. Okay, here we bottomed where we should have. So that was wave A here, and then that was wave B, and this ideally should be wave C, just there. Nothing out of the ordinary just yet. So far, it has followed, simply went through door B. Okay. At that moment in time, I don't know yet if it's going to take door A or B. It's impossible to know. I do know those 2 doors are available with certainty, with 100% certainty. I knew those 2 doors were available. It's been on the charts right here, right there, right now. I can't make it. This is picture perfect, beautiful Elliott wave at work. It doesn't get any better and easier than this. And where are we? We're still only at a 38.2% retrace of this rally of the February 24 flow. Okay, we still are there. So this was not wave 2. And then we should now see, ideally, 5 waves lower. Again, the price action can still be a little bit sloppy over the next, I would say, couple of trading hours, Monday, Tuesday. And then this is wave 3. Still don't know if wave 4 has bottomed or topped or not. I would prefer it 1 step lower. That would be really ideal. We get some positive divergence going, all that good stuff. So then we just use the Fibonacci extensions here. This is then wave 2. Okay, and then we should see a wave 5 ideally materialize just a little bit lower. That's around 42.55, somewhere there. And then we should see, of course, this wave 5 here. Okay, that would be ideal. And then we simply restart the process of setting up for this wave 3C. So these ones are all in the books there. Somewhere should then be ideally here. And again, it depends on which information the market is going to digest and how it's going to interpret it. And then the cutoff is quite simply here. is 4345, right? If we go over 4345, then odds increase tremendously that we've completed wave 2B. Now I'm also going to show you again, of course, the alternative, that we have a larger fourth wave on our hands. Save changes. Yes, please. Fantastic. Okay, and that is, the first one is with the semiconductors and the second one with the Dow Jones. Okay, that this is a wave 4, that we had wave 1, wave 2, and then this is wave 3, and this is wave 4, and then we're still going to go to a step lower below the February lows. Okay, that is still possible. That remains still on the table. So here's the semiconductors. Semiconductors bottomed exactly at the 76.4% retrace. So these ones are really on the cusp of invalidating this 1-2 setup. Okay. I showed you on Wednesday that we had 3 waves lower into the ideal target zone here, and we had 3 waves up on Wednesday. That's what I showed you. And so far it's been only 3 waves up. We didn't get a 4 and a 5 in the semiconductors. Okay, the semiconductors only had 3 waves up. I labeled it accordingly. So this is why you always need to label everything 1A, 2B, 3C. Okay, until proven otherwise. So that is then C. So that is a bounce. Okay, so then we had here 3 waves lower. This is A, and this is B. If this is a flat, okay, and this is C. Excellent. We had a picture perfect. I'm going to do it here in orange, because we have to upgrade the wave degree. A picture perfect 161.8% extension. See this? This was the target zone. And then this is, of course, wave C. And that was not wave 2B, but wave A of 2B, in my humble opinion, with the caveat that we can still move a little bit lower. So then we got 3 waves higher, not 5. Okay, loud and clear. So that is then B. B waves are always 3 waves. Perfect. So far, Elliott wave is moving along fantastically well. And now we should then see if this is a flat correction, 5 waves lower. Okay, so here we go. 1 looks good, and that should then be wave 2. That is good so far as well. And then we have 1, 2, 3, 4, 5. So this one suggests that we are here at wave 3. Okay, there, wave 3. Wave 4 potentially, not necessarily, because wave 3 and 4 can already be there. And then potentially a last wave 5. Okay, we don't have negative divergence yet on the RSI 5 on the hourly time frame, as you can see, right? So we don't have that yet. So this would also look lower with a marginal lower low. Again, very simple. If we go above 3328, somewhere around there, from current levels, odds are that we've bottomed for wave 2B. Okay, again, wave 2B can also be there. 76.4% retrace. I showed you this already, that we can bottom anywhere there. You just don't know where exactly. Once we have completed 5 waves, you cannot say where exactly the correction is going to end. You can say after 5 waves up, you must expect at the minimum 3 waves lower, and that's what we got. After 3 waves lower, expect at the minimum 3 waves back up, because we can turn this into a flat 335. And that's exactly what we got. The market could also have decided that was all of this wave 2, right? But unfortunately, more bad news became available before good news became available. And this is the end result. Now I'm going to show you the daily chart of the semiconductors, and I've shared that with you before. And that is that we can still have this wave 4 and are in this wave 5 of a ending diagonal wave 5 of C of 4. Okay, so this is still possible. That will happen again on a break below the February low. The semiconductors are still the weakest of indexes, because the regular Nasdaq has not even done a 50% retrace. Nasdaq 100 not even a 50% retrace. S&P 500 is relatively strong, only a 38.2% retrace. So all things considered, right? We only have done a 38.2% retrace so far of the rally that lasted for 3 days, pretty much. So that's reasonably bullish. We should, according to all the news and everybody's opinion, Chicken Littles and all that stuff have been now at S&P 2000, preferably 0, because according to some, it's the end of the world. God forbid it is. I don't think so. And so far, the market seems to tell us it's not either. Then let's move on to the Dow Jones. So Dow Jones still has this Alt 4, just as I showed you for the semiconductors. It's still possible. Okay, it's still possible. We're not entirely out of the woods, because what that would mean, if we simply do the Alt 4 count, is that this wave 4 moves here. Then you had 1A, 2B, and then this is then C. So this could still be possible. Okay, this could still be possible. Then we had A, B, C like this. That is still very possible. But so far, let's have a look. Okay, let's have a look at the short term once again. So we said if this is a wave 2/B, it should bottom anywhere around this thickly shaded green target zone. Bingo. My name is Bingo. So far, so good. Okay. Then I said we should bottom for this wave C initially here. Okay, that's what we got. Fantastic. Now let's look here. Okay, do we have 5 waves lower? Okay, so we can determine this as 1. Okay, 2, 3, 4, maybe a failed fifth to be determined. Okay, to be determined, we cannot move above this level. So you can see this Dow Jones is a little bit different, 33640. Okay, this is the 33640. This is the cutoff. We don't want to go above it because that would be not so good for the bears. Okay, so we're back here. So could this have been a wave 1 already? Okay, so I'll leave this here for now, 1A. And now I am a little bit less certain about the Dow Jones, because the Dow Jones might be more bullish, just to show you that we have differences in indexes. And then this should be B. But I also wanted to show you that we can still be in this 4th wave. Okay, again, below the February 20, nothing out of the ordinary. And then we target for the S&P 500 in the low 4,000s. And then we can start major 5. So please remember that every index is slightly different. So there, this could be 3, and then 2. So we're getting very close here to this overlap. We already had this overlap, but it's about closing prices. So we'll just leave it for now as is. And 4. Of course, as usual, if we break above this week's highs, I have nothing but the option left that we are in wave 3C, right? That's the blue arrow. Above that level, 3C. Okay, so gotta watch that. So that remains still on the table. So everything from Monday and Wednesday remains exactly the same. Nothing has changed. Slightly a little bit lower, fine with me. Doesn't have to. Dow Jones doesn't have to. Okay, doesn't have to. So again, there's still a nice method to the madness. IWM. So here's the IWM. Haven't changed anything about the chart on Wednesday either. Let's get to work. In my humble opinion, we had 5 waves higher. That was kind of determined. Okay, so then we say, okay, this is wave 5, and then I'll just delete this here. This is then wave 3. We'll update the chart. So this is now set in stone, and then we have wave 1A. We have A, B, C lower. Looks like it. Okay, pretty good. And then I wondered if this was 1/B, and it turned into wave B. So this is then wave A, right? Because we moved below the start of this rally. And then it can't be a first wave anymore. Excellent. So this is then a B, and this is then a wave A. Okay. And now we're going to see how low then the retrace should be for this irregular expanded flat. Okay, so this can still move a little bit higher. So see this, nothing has changed here. This was the C wave so far. This is what I said. If it's a wave 2, we should bottom here. If we break below 201, so far, so good. So nothing has changed that perspective. And let's redo that. That is wave C. This is what I forecasted if we would break below that level. And we didn't break out. Okay, so we failed the breakout. Excellent. And that is wave C. So how many waves lower do we have on this one so far? Still also looks a little bit better with another lower low. It doesn't have to be on big tech, but every single index is different. And I really want to focus on the short term here to make sure we narrow it down completely and fully understand where we are. So once we have this narrowed down and we hopefully get the breakout, then we should be in a much better shape, so to say. And then this is 4, and then we can still do a wave 5. Okay. We'll know soon enough by Monday and Tuesday which of the two it is. For now, this is tracking along nicely, 2 out of 2. So maybe I'm going to get the next turn wrong. Again, we're still only at around a 50% retrace, nothing out of the ordinary just yet. All right, so we have gone over all these indexes. To recap, still looks like a irregular expanded flat for the Nasdaq. Still looks like a irregular expanded flat for the Nasdaq 100. Okay, so I'm going to take this one. Still also looks here like an irregular expanded flat for the S&P 500. Semiconductors can still try to move below the February lows. Those are the line in the sand now. The previous line in the sand was the Tuesday's lows for the 1-2 setup. That was negated. So now we're back to 1-2 setup, or AB. Semiconductors can still try to move lower for it being a wave 4. And that also still applies for the S&P 500, by the way, as long as the I cannot say it often enough, February lows. Dow Jones has that same potential, that we had A, B, C up for 4 and are now subdividing lower, I would say probably into the around 30,000. IWM looks also good here, maybe a little step lower. Breakout above last week's high for all indexes means that the wave 3C is underway. New lows, let's go to market breadth, is still concerning. It's still very concerning. It's high. So that's not a good sign. The PMO buy all indicator remains on a buy since late February. Believe it or not, it remains on a buy despite all the negativity and the down price action we've seen. Can it top out? Yes, but it remains on a buy. Bullish percent index for the Nasdaq 100 remains above its 5-day simple moving average. When it is above its 5-day moving average, good things tend to happen. 9 out of 10 times, good things tend to happen. So it needs to hold it. Same here for the S&P 500. It's still above the 5-day moving average, which is the orange line. Every time it's above the 5-day moving average, good things tend to happen. Let's look at market breadth. This is the McLaren oscillator for the S&P 500. It didn't do much on Friday. Okay, we actually have a higher high in the McLaren oscillator compared to I think last week's high or early this week's high. So that is good. It remains on a buy, but it's not much. It's minus, it's negative. So we need to see continued upside. Let's look at the summation index of the Nasdaq 100. Summation index adds the McLaren oscillator from yesterday to that for today, etc., etc. So negative values lead to a decline in the summation index, which means the McLaren oscillator is negative. It means that more stocks are declining than advancing. As you can see, it's getting close to historic lows. All right, we're at minus 600 summation index, which has happened before, especially during bear markets. But you can also see when it gets this low, we often have fantastic buying opportunities. Okay, so we're getting quite historically low, especially considering the bull market that started in 2009, which has only seen readings below 665, 1, 2, 3, 4, 5, 6, 7, 8 times. So this is quite a once in a year type of low. Let's see if it holds. It doesn't forecast anywhere it will bottom, but just goes to show it. These are very low oversold readings, with the notion that, of course, oversold can always get more oversold. How we're doing sentiment-wise. So this is the active money managers index, and they're heavily underexposed to market, right? Heavily underexposed, 30% allocation in the market, 70% cash pretty much. As you can see here, those are often levels associated with close to important lows. Can drop much lower, but it shows you we're getting quite at historic lows. This data only goes back to 2006, so it's not very long, but it shows that we're getting quite underexposed, and often that's a contrarian signal. How are mom and pops doing? They're still reasonably bearish, but definitely improved on the bullish side, so to say. After last week's lowest reading in a year, we're kind of back to a little bit more to neutral. All right, then let's have a look at seasonality. Seasonality always plays an important role because everything plays an important role in the markets. Everything must be considered. Elliott wave, technical analysis, market breadth, sentiment, all those things. Seasonality, also important. Seasonality shows us that we should bottom somewhere in early to mid-March and then rally essentially for the rest of the year with potential for the first decline in the summer months, May, June, July. Okay, so this is the average seasonality for the S&P 500. Again, as this is from Adam Mancini, despite headlines, the S&P 500 seasonality continues its perfect track record for the year. Please keep that in mind. We got the January sell-off, we got the early February rally, then we got the mid-February meltdown. Yeah, so if this continues to track, by early March, we should see a multi-month seasonal low and then a multi-month rally. This, of course, fits with the notion that then Major 5 should be underway. So we could be very close. Again, it doesn't have to follow the pattern exactly as shown, that we should see lower lows, but it shows kind of the general direction. So this fits pretty well. This is from Brian Detrick, a tweet also about seasonality. This is the midterm year stock trend. Okay, yes, it's midterm year. And we should see weakness January, February, March, and then strength into May. Okay, so this fits pretty well here as well. Strength into May, or as they say, sell in May and go away. Okay, 2022 is playing out nicely again compared to the average midterm year seasonality. So far, nothing out of the ordinary. Excellent. Okay. Now we're going to zoom into some bigger picture stuff. Okay, this is an article just by came out last week. It's free. You can look it up at the McOscillator from Tom McClellan, where he is looking at the yield curve cycle. He can go into all details, but pretty much his conclusion is the following based on this. Okay. He says a generally favorable time for stock prices until 2024. Remember, my forecast still remains that we'll see a bigger crash in 2024 and not before it. Remember, not before it, okay? Some of these gains are unfortunately already diminished, he said, due to the Federal's quantitative easing, all that stuff. But he said starting in mid-2024, the stock market is in for a pretty difficult time. But until then, generally favorable time for stock markets and prices, okay? Excellent. I agree with that. So the coming rally might last that long, but we might top out, and the top can take a long time to develop, which they often do. It takes months and months before a top is really finally confirmed. Then I'm going to go back to Tom McClellan's crude oil's 10-year message. Okay, he was originally looking for a massive market top April 2011. Well, that came and went. That didn't happen, but the bigger picture here is that we should see a crash in 2024 once again. That's my main point. What you can also see here is that, again, it's not about the magnitude of the moves. It is about the general path of the moves. And as Tom clearly stated, the 10-year message, to clarify, is not exactly if it's happened in April 2011, it doesn't mean it has to happen in April 2021. It's literally plus or minus. He ideally says 6 months, but it can also be plus or minus a year. It's not exactly 10 years. If this is something that has lasted for 120 years, you got to give it a break. So it's not a very good timing tool other than for really large moves. And I would say 9 out of 10 out of these larger moves have been captured by this 10-year delay between oil prices and what the stock market is going to do. Okay, so when oil peaked in June 2018, we eventually got a crash 10 years later in the stock markets, which was somewhere around 2018 into 2019, etc., etc. So we can move all of this forward. There's enough evidence to say this holds up really well. So what would we see then? We saw a top in the markets in September, October 2021 when we had our first 10% correction. Since then, the trend has been in general higher. You can see the market has since rallied, okay, and is now in a rough time. Okay, fits well, right? 2022 is off to a rough start. Again, it's not about the exact same magnitude of these price changes. It's just a general direction. And then we should see good times, because then the direction is higher. That's what matters, the direction, not the magnitude. And then the crash. So that fits with the flattening curve that you saw here as well for the yield curve, okay? And again, it's not exactly 10 years, so give it a little bit of break. Then we can look at, for example, a market timer that has had an excellent track record, doesn't capture everything, who is looking for very high stock prices into 2022, 2023, and then a crash in 2024. This is stuff by Mr. Gunn. Okay, so that aligns reasonably well with what we should see for oil prices in 24, and based, as again here, oil price in 24, and this yield curve also topping out in 2024. So that's the bigger picture, okay? Again, when exactly things are going to top, if it's going to be April or March or 2023 or etc., I don't think that's really necessary. It's about the general picture. Shorter term, also here, seasonality is what we should expect, right? We anticipate, we monitor, we adjust, and we take all of this data into consideration, because all of it matters, all of it. Bottom line, this is from Wednesday's update in smaller letters and italic, and then today's update is below it, summarized. Wednesday's update was correct, okay? So was Monday's update. So far, so good. Now we'll watch and wait for the market to throw a curveball. Okay, so we had the 1A completed, and now in wave 2B. Wave 2B became more complex. Welcome to corrections. After 3 waves lower, expect at least 3 waves back up for a potential flat. So wave 1A is complete, and as long as the February 24 lows hold, wave 2B can also be considered close to complete or complete as an irregular flat for most indexes. Okay, indexes have reached the ideal downside target zones on Tuesday and Friday, as I forecasted on Monday and Wednesday. I showed you that we're right there. Okay, this is the power of Elliott wave. There's method to the madness. Most indexes have reached normal, standard, typical, nothing out of the ordinary, mundane retrace levels of the impulse, 50 to 62%. This gives me continued confidence that my work is correct. And it shows, more importantly, there's truly a method to the madness. Markets are really doing Fibonacci ping pong, right? It's beautiful. Now the semiconductors retrace the most of all these indexes and can still try to go below the February 24 low with this ending diagonal as you showed you. The same for the Dow Jones, it is still possible. However, a breakout above the 1A high, which is last week's high or the week before that, will allow me to better forecast the wave 3C, 4, and 5 of ideally wave 1 of 5 of 5 of C of 3, etc., etc. Okay, I showed you this on Wednesday, but we have to give it some time because we did go low below Tuesday's low, so some of those upside targets have to be reduced a little bit. Well, I'm going to revisit them once we see the breakouts. Okay, if we see breakdowns, then we'll revisit those. Sentiment is still reasonably bearish. Right, if we look at the active money managers, quite lows. Individual investors improved a little bit, but still more bearish than bullish. Market breadth is reasonably okay. I showed you the McClellan oscillator for the S&P 500. I showed you the bullish percent indexes for the S&P 500 and the Nasdaq above their 5-day moving averages. All things considered, on Friday, it could have been a lot worse. So market breadth is reasonably okay. The buy all indicator is still on a buy. So with that, I think I hopefully gave a good short-term to big picture review. Things are still tracking along quite nicely. Neil, 2 out of 2, so to say. We got the irregular flat. We're in the normal ideal wave 2 target zones. Semiconductors, Dow Jones are still on watch. Again, we can go below the February 24 lows. It's still possible. Then we'll have to morph this into the wave 4 with a B, and a C. A being the top made quickly after the February 24 low. Wave A is that. Wave B was then last Tuesday's low, and wave B was last Thursday's high, and now we're impulsing lower into S&P 4000. But for now, that is not my preferred view. My preferred view is also based on seasonality, that we're soon going to enter a very bullish phase for the markets, and that would fit with a top into 2024-ish, something around there. So I wouldn't be surprised if we're going to last for a lot longer for this bull market than anticipated. So that's okay. Just to give you a general time frame and what's still going on short to long term. So with that, thank you so much for listening. Take care, trade safe, and I'll see you all on Monday. Bye.